Hello and welcome to Market Today. I am Siddharth Zarabi and joining me now is Shankar Raman, the President, Full-Time Director and CFO of L&T. Welcome to the show, Mr. Raman. And before we start, I just want to offer you congratulations and our heartiest best wishes for a great tenure now with your new appointment. Um, and it's very nice to have you on the show with us
Thank
today.
you. Very, very kind of you. Thank you.
I want to begin by asking you to sort of give us a recap of the very strong, well-rounded performance that we have seen across all parameters for the fourth quarter. Revenues about 67,000 crore, a growth of 15%, and profit up 10%. Take us through the overall financial performance, Mr. Ram.
Thank you. I will do that. Good morning to you and to your viewers. I think the performance of the company in FY24 endorses, in a very broad sense, continuity of investment-led growth that the economy has been adopting. This is not an overnight development. It's a culmination of 3-4 years of sustained investment and stability of policy towards building India in multiple spheres. Unfortunately, L&T straddles many of these areas, so I was very happy to contribute to this entire growth of the country in terms of its economic well-being. But having said that, we always were viewing FY24 as a robust year because we knew that was a year that was leading up to the election. So much of the program we expected would receive priority in terms of clearances, approvals, and the push that is required from the sponsors. And true to that assessment, we've had a extremely satisfying year in terms of winning orders, 30% more than what we did last year. We started the year with possibly a 10% growth guidance last year. But we were pleasantly surprised when the Middle Eastern orders also came thick and fast and joined forces with the Indian orders and consequently helped us overperform. We were looking at an order book of about 5 lakh crore, maybe closer in FY26. As we speak, we have closed FY24 with 4,75,000 crore. So consequently, I think the targets that we set ourselves for FY26, the way we looked at it in FY21, seem now within reach, maybe a year in advance. The year was particularly satisfying because of the range of projects that got announced. It was not very narrow focused business vertical, which did very well. Of course, the two outstanding businesses was the power transmission distribution, the renewable business that did very well because large orders came from Middle East for solar power projects. And the hydrocarbon business did very well, both in India and overseas. It is also a good tactic that Middle East followed by investing in oil and gas to generate returns at about $80 a barrel to be able to finance all their other developmental needs, including energy transition. India has been doing likewise also. The need for India is more basic and it is more granular. So the sizes of projects in India are much smaller than what we get in Middle East. But consistently through the year, quarter on quarter, we've been able to see orders fructify. The other feature of FY24 was the time that it normally takes between conceiving an order, putting out an RFP, evaluating the tender, technically pre-qualifying bidders, getting financial pre-qualification, getting the financial bids, opening and awarding. This process used to be 9 months to 12 months normally in our system. We found in the last 18-24 months this shrinking, so much so that there are many bids that we submitted in the early part of FY24, which actually awarded by the time the first half of the year ran out. Normally, statistically speaking, about 40% of the orders that we win in a year comes in the first half of the year, and 60% comes in the second half. And of this 60%, bulk of it used to come in quarter 4. So we used to be, whether we liked it or not, very quarter 4 heavy company for meeting the yearly guidance. But last year, FY24, we've been uniformly growing quarter on quarter, so much so, by the time the December ran out, we were almost 75-80% of the total orders that we were targeting in the year in the bag. Now, this is extremely positive because it helps us plan our resource deployment in a more logical manner. We are of the firm belief that India deserves high quality infrastructure but at affordable prices. And that can happen only if project gets done on time within cost. One of the major reasons why we have overruns in India is because we don't value time as much as we value money. There's a lot of focus on being L1, being the lowest cost, provider of infrastructure services, but we actually accept if there is a 24-month delay. What the international markets do is quite the opposite. They actually expect you to partner them in completing ahead of time, and to that extent, if they have to stretch their budget to make sure that the liquidity exists with the supply chain, to make sure that they're able to manage their inventory, buy out their goods and services, is a focus of the project sponsor as well. So the entire philosophy of project execution, if the project sponsors in India, and largely government, because it's some form of the other, the government gets involved, not directly, state or central government, but through their arms. They are the major project sponsors. 75% of what we do come from such avenues only. So it's very important if this project perspective changes, India will do much better, and consequently L&D will do much better.
Do you expect that once a new government is in place and starts work in June, markets are factoring in a return of the present dispensation, and the government has said that we have a 100-day plan which is set to be finalized. Do you expect that the poll-related sort of slowdown, if I may use that word, will get tempered off beginning June onwards?
Let me also add a dimension to this. I think the bids have been submitted quite regularly until the code of conduct really kicked in. So the government, whichever government which assumes office, is going to have an opening stock of bids submitted due to be opened. So I think that would possibly be the low-hanging fruits to start with. For new programs to be announced, on the basis of this 100-day program that you alluded to, on the basis of what it would mean in terms of budgetary support, on the basis of budget that possibly will get announced on 1st of July, etc., I expect only from August that the momentum towards new order to pick up. So to some extent, the 10% guidance that we had given on the order inflow for FY25 factors in a 7-month period rather than a 12-month period. And if the government starts with opening the bids submitted and awarding them, then they will possibly be off to a more brisk start than what normally happens whenever there is a union election. Because almost 6 months goes past by the time the rhythm returns to the functioning of the government. Economic continuity and policy continuity will help. So to that extent, I think time lost in trying to understand how to approach this whole system of growth can be saved if there is continuity. But who knows? I think it's a democracy. We'll have to wait for the results.
We'll have to wait for that. Mr. Raman, before I move on to other questions, top of mind, is it possible for you to kind of put together and offer a number for our viewers to digest of how much of this order execution is currently waiting for a new government to come in and then start approving?
I can only speak from the context of our company because I do not know what is the tally that the government has from so many other quarters. There's so many people who bid. According to me, at least 20,000 to 30,000 crores worth of orders are something that the government can quickly get on board. And these are largely continuation of some of the existing programs. They are also not necessarily new programs, completely zero base. So my sense is that of that order of magnitude, in the context of the business interest our company has, is what I anticipate to be the first wins.
Mr. Raman, is weaker than expected margins guidance, obviously for the current year, contributing to a bit of the disappointment that we have seen in the market? in the immediate aftermath of the numbers being out?
Thank you for touching on that, because I think this deserves some explanation, because I don't think it is well understood. I think people saw us print for projects and manufacturing business an operating margin of 8.6% last year, FY23, and they saw that number decline to 8.2 in FY24, and this whole mood changed, saying that the profitability is dipping. What is missing everybody's attention is the revenues, the resources that we deployed to earn that 8.6% last year was almost 18-19% of the revenues. The resources that we deployed in FY24 to earn that 8.2% is 12% of the revenues. This is a significant conservation of revenues earned to generate that profitability. Secondly, the fact that 40% of our order book comes from international markets is also contributing to this new trajectory. In international markets, as I spoke a little earlier, a lot of focus is given on cash flows being pumped into the project early on and through the course. In India, the cash flows gets pumped into the projects towards the end of the project. So if you factor for time value of money, I might make 9%, let's say, on an Indian project, but I'll get my money, let's say, 18 to 24 months beyond time. And if I'm going to get, let's say, 8% margin in international projects, but I'm going to get the money upfront or well in time, I think the time value of money kicks in which is the reason why, despite the margin coming down from 8.6 to 8.2, the return on capital invested has gone up by 200 basis points and the ROE has gone up by 270 basis points. So the value creation has multiple levers. One lever is the absolute margin. The other lever is the resources that you deploy to earn that margin. And I think as a company, we are focused on creating value. The levers have their own dynamics and they will change depending on the type of order, size of order, geography, etc. So my suggestion to the markets would be not to unduly stress over an absolute number of 8.2 or 8.6, but see how the return on investment plays out. And from that perspective, I will take the 8.25, 8.5 range, given the 12-15% resource intensity, any day over a 9% or 9.25% with a 20% resource intensity.
One follow-up on this, and I'm looking at ICICI Securities report, which says that core EBITDA margin guidance is muted owing to unfavorable mix of projects under execution. Now, would you want to explain what is perhaps being alluded to so that there is better clarity on this aspect of unfavorable mix of projects under execution?
Yeah. See, in the previous years, when the margin post-COVID had declined, we had orders in our book which was exposed to commodity price. And as you will remember, the commodity prices shot through the roof. And no amount of mathematical calculation could have prepared us for that kind of swing that we had in the prices. So the company at one point in time had to execute projects which had unfavorable commodity prices featuring its cost lines. And that over time, as we completed executing those projects, have reduced. Today, the orders that we won in 2021, etc., are a very small percentage of the total order book. The order book that we have largely reflects the more recent orders. So the brokerages normally track about how much of remnants of the old orders that the company has. And a bit of commentary on that unfavorable mix could be that the last of those will also play out during FY25. So FY26, we could have possibly a relatively brand new order book. Secondly, the mix of domestic and international, as I told, in 21, 22, etc., we had almost 20% international. Today, we are having 40%. Now, the mix does not mean unfavorable from an overall business perspective, but from the absolute number of margin movement, the mix does have an influence. As I mentioned, Middle Eastern margins are 1 to 2% lower in terms of margins as compared to Indian projects, but they more than make this up by making sure that the resources that are available to us is far more front-ended. So when we approach Middle East, we can't approach Middle East as, am I making 8, 9, 10%? Am I making 10% in India? Am I interested in making 8% in Middle East? That's not the way to do. I'm making 10% on water resource base and making 8% on water resource base. And so long as the mix is favorable, I think the business mix of higher international does not hurt the overall value creation. But sometimes I think patience to understand these levers is short from a market perspective, because they do go by the top line and form immediate reaction. So to that extent, I think it has caused some volatility. But as people begin to understand the details, I'm sure, I think their confidence on the stock will return.
I'll take one more follow-up on this point, because you made some very important comments. In terms of the order inflow prospects, can you give us a breakdown, including on infra, hydro, carbon power, and others, and what is the relative change, if any, between what happened in the previous period?
I think the areas which have been very productive for us has been infrastructure, and within infrastructure, we've had our buildings and factories do well. New spurt of buildings that are coming up, either in form of factories for their capacity expansion, for construction material, because cement factories are expanding, paint factories are expanding, etc. Steel factories are expanding. So though and real estate has in a way got revived, both residential and commercial, and the data center, with the world going digital and India having a large footprint of personal data, the need for data residency, etc., has created enormous scope for building data centers. Data centers can work efficiently only if there is uninterrupted power supply. So that has a trigger on power generation. While India may not be able to move away completely from coal for power supply in the immediate or medium term, because of the storage solutions are not yet efficiently found, we do think that green power will increasingly have a role. Investment in renewable will pick up. Both the government-led investments and private sector-led investments will happen. And if you're going to build data center, you need to have power. So green power would be an add-on to attract hyperscalers who are all committed to investing in green assets. There are also a lot of international green funds which back up all of this. So I find that in the whole area of civil, electrical, mechanical construction, the opportunities to be extremely robust. India is also strengthening its border infrastructure. The investments that it is doing in terms of work that our heavy civil business will be engaged in, because upcountry it is mountains and scope for hydropower, as well as tunnels because of the mountainous region, etc. So we do think heavy civil is in a good shape to take advantage of some of these things. We also have our water business, which has been a constant provider of growth for us, because India is water stressed. I think even as we speak today, not every corner of India has reliable supply of water, potable water. Likewise, some of the industries which are coming up, like the semiconductor industry, would require a lot of water supplies, and we can't use potable water for that. So there is going to be industrial desalination plants that's going to come up. As cities are burgeoning and growing, we're going to find solutions for urban transportation. We also need to find solution for effluent treatment. So these businesses will also benefit. So if I look in the whole area of infrastructure, and I'm not even covering the continuation of the dedicated freight corridor, the high-speed corridor, the rapid rail transit systems between cities, and the hubs that has to develop, connecting the freight corridors with the industrial corridors, all that are opportunities waiting to be tapped. We're also talking about larger people visiting India, so the expansion of airport infrastructure, railroad infrastructure, station developments, etc. are also in the offing. So to my mind, the enormity of what lies ahead is huge, and L&T needs to be very smart in picking up the right spots for it to put its resources, because it also has limited number of resources that it can deploy. How many people can we, as it is, as we speak, we have almost 600,000 people working in some form or the other across our 1,000 projects. both in the country and outside the country. How many more 600,000 people can we put together of the right skill? So skill building is going to be key, and selectivity is going to be key, but opportunities are plenty.
One quick point, given the overall current mix that you see, which sector do you feel will be a consistent outperformer, in the sense the infra story is well known, but within the overall mix of your businesses, anything that you can point to investors which will continue to provide stellar returns in the near future?
See, I think there are 70% of what we are engaged is in infrastructure. So very difficult to take infrastructure out of our tongues in terms of comments. But outside of infrastructure, I think manufacturing is getting its attention, and some of the areas where we could be participating and benefiting from China Plus One will get attention, and that will give us an opportunity to build those plants. We already see the thrust towards semiconductor. Though personally, L&T has decided to be at the design end and not at the fab end, but a lot of investments would be required there. We already see enormous investments in the area of telecommunication. I mean, the kind of communication, mobile telephony penetration, and the sourcing of those gadgets from India is an enormous opportunity. Battery storage is another area where I think country has to pay a lot of attention on, and renewable power. So according to me, these would be 3-4 major areas where I expect country to take definitive strides in the next term of the government, whichever government.
Mr. Raman, can you provide any more detail on what could be future non-core business divestment plans? As I understand, in line with your Lakshya 2026 plan, IDPL already done. So, are there any other businesses that you can speak about?
Much of the divestment that we identified to be done in the period FY21, FY26 is done with now. We have Hyderabad Metro pending, which is the last of the concession business, apart from the Nabha Power in Punjab. Nabha Power is in a good place because the plant is working efficiently. Punjab is dependent on this asset. So we are generating revenue of 4,000 crores, profit of 400 crores. So that's quite okay. But idea is not to run the power plant. So at some point in time, that has to be completed. And secondly, Hyderabad Metro. Hyderabad Metro is a 65-year concession to run metro system in the city of Hyderabad. We currently have 4,75,000, 4,80,000 people per day using the metro network. We need to make sure that this number goes up by at least another 100,000 people. We need to lighten the debt burden of this project because of the current level of ridership that we are able to see. So we have negotiated successfully with the government for a 3,000 crore soft loan to be repaid over time without any interest. We've got about a third of that drawn. The balance 2/3 has to be drawn and will be used to repay the debt that we otherwise have on the balance sheet. We also have to monetize some of the real estate that is attached to the metro. The government has given permission for one level, which we have completed last year. There are a few more levels that needs to be done. We hope in 25 and 26, we should be able to progress on that as well. My own assessment is if we do all these things, by the time we sit down for FY26, FY31 plan, this could be an asset to be monetized in that period, because the asset would then be of interest to investors, particularly the pension funds and global funds, given the 65-year concession that it has got. What else will add to non-core? Every 5 years, we do this check on what's going to be relevant for the future, what is not necessarily relevant. And we keep on identifying. We've been doing this for last 20 years. And over time, we have been divesting some business or the other and trying to seed some businesses or other. So now we have put our bets on hydrogen, electrolyzer manufacturing. We have put our bet on semiconductor. We have put our bet on data center. These are new streams, and some e-commerce platforms that we have developed. Now we'll have to see how, as we shed the non-core, as we saw earlier, which of the current businesses, including the new ones, are due for scaling up. And the next 5 years, possibly, will focus more on scaling those up rather than shedding any overweight. I think we are pretty much done dusted on that front as I see it today.
Since you mentioned Hyderabad Metro, my understanding is that the free bus service had an impact as far as ridership is concerned. And since you outlined a detailed plan, do you think at some point the free bus offered by the state government will kind of even out as far as your ridership numbers are concerned?
It's made metro ridership less interesting because it has taken away the women from the compartments, and since the women are occupying the buses and the number of buses has not increased, the men from buses are moving into the railway wagons. So there is a gender distribution that is happening in the transportation system. Buses are being used by women who pay nothing, and metro is used by men who pay 35 rupees on an average per ticket. But we do think it's not sustainable because some of these SOPs, which are done on the back of political promises, etc., is not going to help the state finances, because what is the point in making the transport corporation of Telangana or Hyderabad go bankrupt? There's no fun in doing that. And secondly, these are depreciable assets because every 5 years the fleet of buses needs to be invested in. So where is the money going to come from unless the users pay? So somewhere this public-private partnership works at cross purposes. Private capital is required to put a modern zero polluting transport system. At the same time, we are spending money in making people use the polluting buses. So it's a bit of a conflict there, but I guess the political ideology and the economic interest and the ESG, it takes effort to align all of this. It doesn't naturally do it on its own. But we are hopeful as a country we will get there.
Mr. Raman, you just provided a glimpse into some of the complexities of doing business on the ground in a country as vast and diverse as Bharat. And I believe anybody who has even a remote interest in the issue of public-private partnership will take note of this fact and how certain decisions can have downstream impacts of the kind that no one anticipated. But for your company with its vast operating mix and massive balance sheet, I guess this is one of the challenges that you will take in your stride. You've taken out a lot of time to go through some of the fine print of your results performance. I thank you for that and wish you all the very best. Look forward to seeing you soon at the next quarter announcement.
Thank you very much, and all the very best to you and your viewers.
With that, it's a wrap on this conversation with L&T. We'll be back with more. Until then, goodbye.
The key stocks are concerned, where are you keeping your focus? Is auto on your top radar too?